We welcome you all to today's edition of Money Moves. I am Melissa Enoch here at the FMDQ studios in Lagos.
And I'm Grace Egberago. It's Wednesday, the 15th of July. We thank you for joining us at this time on the show.
All right, let's begin with news now. Nigeria's Composite Purchasing Managers Index returned to expansion in June, rising to 50.1 points from 49.6 in May, ending 2 consecutive months of contraction. The recovery was driven by the agriculture sector, while the PMI rose to 52.1 points, while the industry and services sectors remained in contraction at 49.5 and 49.4 points, respectively. Output and employment remained in expansion, while input cost pressures eased. However, new orders stayed below the 50-point threshold, suggesting the recovery remains fragile and not yet broad-based. In the meantime, the Bank of Angola has cut its benchmark interest rate by 125 basis points to 15.75%, continuing its monetary easing cycle as inflation continues to moderate. The decision follows a 50 basis point cut in May and comes after annual inflation slowed to 10.11% in June, down from 10.88% in May and 19.73% a year earlier. Governor Manuel Tiago Diaz said the central bank expects inflation to continue declining despite geopolitical risks in the Middle East. The bank has lowered its 2026 year-end inflation forecast to 8.6% from 11.5% and raised its economic growth projection to 3.6%, citing improving macroeconomic conditions. In Ethiopia, the National Bank has reviewed its monetary policy at its July meeting as it continues efforts to maintain price and financial stability. Ayob Tolina discusses the central bank's latest policy decisions and the outlook for Ethiopia's economy. Let's listen.
Headline inflation has risen again, driven by fuel supply disruptions arising from the conflict in the Middle East. Inflation stood at 13.4% in May, up from 11.7% in April and 9.7% in December, with both food inflation at 15% and non-food inflation at 11% contributing to this increase. The committee's assessment is that inflation is likely to remain in double digits over the 6 months forecast horizon, with possible moderation by December 2026. On growth, the committee noted that the Ethiopian economy has sustained growth momentum over the past 8 years, with real GDP growth averaging 7.5%. In fiscal 24-25, growth reached 9.2%, while growth is projected at 10.2% for fiscal year 25-26. High-frequency indicators monitored by the National Bank point to continued strength in manufacturing, such as cement, electricity generation, and iron and steel output, and in services, particularly tourism and air transport. On the other hand, export volumes of coffee and oilseeds and import volumes of raw materials and petroleum have declined relative to the same period last year. On monetary developments, reserve money growth has decelerated to 43% year-on-year in fiscal year 25-26 from 66.4% in the same period last year, though it remains elevated, driven mainly by the accumulation of net foreign assets from gold operations. World money growth also moderated to 32.7% from 35.2%, with the growth now driven by both net foreign asset and domestic credit, in contrast to the pre-reform period when domestic credit alone was the dominant factor. On interest rates, short-term market interest rates have remained positive in real terms. The weighted average T-bill yield declined to 12.3% in May 2026 from 15.5% a year earlier, with 91-day yield falling to 11% from 16.1%.
Still in the region, the Food and Agriculture Organization, FAO, has warned that Ethiopian coffee farmers face growing risks from climate change, price volatility and disease threatening millions of rural livelihoods. The report also highlights similar challenges for cocoa producers in Ivory Coast and Ghana, as well as coffee farmers in Uganda amid extreme weather and sharp global commodity price swings. The FAO is calling for greater investment in climate-resilient farming, improved market transparency, and expanded local processing and certification to help farmers increase incomes and reduce their exposure to future shocks. In other news, the United Nations is calling for a broader approach to measuring progress, saying GDP alone does not capture overall well-being or sustainable development. The session explores why countries should look beyond economic output to include social, environmental, and human development indicators. Let's pay attention.
Social services and well-being, and I think that's and welfare, and that's something that we are known for, revered for. About 15 years ago, under the then Prime Minister, we started producing measures of national well-being with a national consultation at that time. We now have about 59 indicators that we report against on a regular basis. So as Rodolfo was saying, that covers things from sort of environmental concerns, so how much are we contributing towards greenhouse gases, or what's the usage of renewable energy, through to kind of personal well-being questions like how satisfied are you in your life today, or how happy were you yesterday, which, you don't have to answer that now. Other things like voter turnout or safety, on the streets. How safe do you feel where you live? How satisfied people are with where they live? All these different factors that obviously, GDP itself can't give you a sense of, and that is kind of directly relevant to people's productivity, people's engagement with the labour market. So I guess for us it's been, thinking about how the well-being indicators are part and parcel of how we understand what contributes to growth. So we don't see them as different elements. I think that's often maybe a criticism of the Beyond GDP conversation, is that that's different from a focus on GDP. I think we would see it as providing the sort of quality assessment and qualitative understanding sort of behind what drives sustainable and inclusive growth. Social services and well-being, and I think that's and welfare, and that's something that we are.
Meanwhile, Nigeria, Ghana, Cote d'Ivoire, and Cameroon are set to form a new Cocoa Value Addition Alliance aimed at expanding local processing and reducing dependence on raw cocoa exports. The four countries, which produce about 70% of the world's cocoa, are expected to sign the Abuja Declaration at the Cocoa Value Addition Summit 2026 in Nigeria. The alliance will promote the local production of higher value products such as chocolate, cocoa powder, and cocoa butter, helping to increase export earnings and retain more value within Africa. In Mozambique, the government has approved the creation of the National Petroleum Product Procurement Company, ENAPP, a state-owned enterprise that will take exclusive responsibility for the procurement and management of fuel supplies for the domestic market. The new entity will oversee the planning, contraction, coordination, and monitoring of fuel imports, replacing the 30-year-old procurement model that relied on private intermediaries. The government said the reform is aimed at strengthening state control over the fuel supply chain and preventing a repeat of the fuel shortages experienced during the Middle East supply disruptions earlier this year. Finally, on News Now for today, Richard Stewart discusses how Sibanye-Stillwater is optimizing its portfolio to improve margins, boost operational efficiency, and deliver long-term shareholder value. He also highlights the company's diversification strategy, including its lithium business, as it navigates changing market conditions and geopolitical risks. Here are excerpts.
I think the good news for West Africa is that the numbers are likely to be higher than what we saw. It was also interesting to see
the history of Sibanye, and let me just give a very short soundbite. We're a company that started off life as a single commodity gold company in South Africa, and have grown over the years to really a global footprint across multi-commodities. So it was a period of 15 years worth of rapid growth, predominantly through mergers and acquisitions. And that left us with a pretty substantial portfolio, but I dare say also one that became a little bit complicated, perhaps, and with substantial organic opportunity, so substantial resources that we have. And I think the opportunity that we face today is really to look at the portfolio we've got and understand how we could make sure, number one, that it's operating to the best of its ability. How do we make sure that those operations we're getting maximum value out of them? And then ultimately, how we can simplify the balance of the portfolio. And we have the substantial resource base where we see a lot of significant value that can be generated by investing in that. So I think the sort of strategy has almost been a bit of an evolution from one that's been, by necessity, very aggressive growth through M&A. It's delivered a substantial portfolio. And now we're really pivoting to say, how do we optimize the value of that portfolio and almost simplify it? I think when we look at the strategy, it's all about maximizing our margins, ultimately getting the fundamentals of the business right. So maximizing our margins, increasing our efficiency, and ultimately strengthening the balance sheet, returning value to shareholders, and ensuring our sustainability through growth. And that initial growth is organic. So the big pillars that we focused on is what we call performance excellence, and that's very much around maximizing the current business. We focus on simplification.
I am Melissa Enoch, and that's it on News Now for today. The show returns shortly after the break with Grace giving us our market updates. Stick around.
Oil and solar energy. Petroleum is central to the life cycle of solar panels. Photovoltaic cells that convert sunlight into energy are made up of petrochemical-based products. In production, ethylene vinyl acetate, or EVA, is used to laminate and protect the fragile photovoltaic cells. Plastics are utilized in structural frames, wiring insulation, and junction boxes. Gas and diesel-powered vehicles and machines are required during the construction and installation phases, from the chemical makeup of the panels to their production, from clearing the land to installing the panels. Petroleum products play a crucial role in solar energy production. And All Energy's approach is vital to our future.
That would happen within the context of the African Union and the leadership of South Africa, and I do not know whether that discussion has happened or not. But I'm very, very hopeful that the matter will be dealt with at least from the perspective of law enforcement, that that citizens in South Africa, whether they are foreign nationals, documented or undocumented, and South African citizens, that they will be protected from these attacks, and that the law will be upheld, because the problems of South Africa are not caused by Nigerians. The problems of South Africa are not caused by Congolese. They are not caused by Zimbabweans. The problems of South Africa are domestic. Even if all foreign nationals in South Africa were to leave, the problems would remain. So it is a fallacy to suggest that the problems of South Africa are caused by foreign nationals. They are not. On the contrary, Africans in South Africa make a very positive contribution, primarily to the economy, to the cultural diversity and the cultural richness of the country. All of these are very positive attributes which we should be proud of.
Welcome back to Money Moves. Thank you for staying with us. Let's now go over to Grace for a report on how the markets traded today. Hello there again, Grace.
Hi there, Melissa. Let's take a look at how the markets traded today, starting off with the equities. In West Africa and East Africa, the markets are broadly positive, with the NGX All-Share Index gaining 0.24%, while the Barrier of M advanced 1% to 484.27. The Nairobi Securities Exchange edged up 0.17% to 231.51. In Southern Africa, the Johannesburg Stock Exchange slipped 0.10%. Mauritius Semdex also declined 0.33%, same as the Zimbabwe ZSE, falling 0.43% to 452.91. In North Africa, Morocco's MASI eased 0.06%, while Egypt's EGX30 advanced 0.50% to 52,558.39 as at 14:13 GMT. To the currencies, the rand weakened 0.01% to 16.35 against the US dollar, while the Egyptian pound strengthened 0.37% to 50.52. The CFA franc was unchanged at 574.51. The Kenyan shilling was also unchanged at 129.32. And the American dirham weakened 0.17% to 9.33. Meanwhile, the naira was down 0.08% to 1,380 naira 27 kobo as at 12:56 GMT. Let's switch into the commodities data deck, beginning with energy prices. Brent crude gained 0.64% to $85.27, while US WTI rose 0.63%. Natural gas slipped 0.38% to $2.89, while Arabic gasoline advanced 0.87% to $3.25 as at 12:43 GMT. To metals prices, gold fell 0.23%, copper edged down 0.04% to $6.37, platinum rose 0.05% to $1,643.60, while aluminium gained 0.22%. Iron ore climbed up 0.62% to $98.92 as at 12:46 GMT. Finally, to soft commodities, cocoa declined 2.58%, coffee gained 1.13% to $329.80. Cotton rose 0.42% to $81.21. Palm oil advanced 0.96%, and sugar slipped 0.40% to $14.82 as at 12:48 GMT. And that's our Money Moves markets today. Back to you, Melissa.
Grace, thank you very much for those updates on how the markets closed today. And that's it on today's edition of Money Moves. From all of us here at the FMDQ studios, we say thank you for watching and bye for now.